G'day and welcome to another week of Subject to Finance with myself, Andrew Chambers. I've been away for a couple of weeks with not been well with the end of winter blues and with holidays, so there's a bit to catch up on today. There's been actually quite a bit going on. Obviously things are starting to sort of show in terms of where the economy's going, and so I thought I'd sort of do a bit of a recap on the last few weeks and the absence of updates that I've been giving. So the first thing I'm going to start with is CoreLogic data, their house price index, and the general thing coming out of that is that house prices are going up. And it sounds exciting, but if we look at the month of October, we're looking at by 0.4%. If we look at the last quarter, we're looking at 0.1%. So it's really just the start of an increase and indication that things have definitely come off the bottom. Some of the interesting things there, if we look at the month in terms of October, there's certainly some standouts. Hamilton up by 1.3%, Christchurch up by 1.1%, Dunedin up by 0.8%. But interestingly, one of the stars of the last 6 months or year or so, Tauranga, is down by 0.1%. So maybe it's a bit of a lag for Tauranga. They've had some other economic things that have kept them going well. And now they're seeing the tail end of the recession a little bit later than others. It's hard to tell. Auckland is up by 0.2%, so behind New Zealand as a whole, but not looking too bad. Other things there, I think just coming back to Tauranga, if we look at the last quarter, they had a really bad quarter, down 1.4%. So they've actually come back in October and are probably looking a little bit better. Christchurch is probably the star performer of the last quarter. Overall up 1.5% in terms of house prices. And I'll come back to Christchurch, but it seems to have a pretty positive picture actually. In terms of property values, average price in Auckland at the moment around 1.26 million. And the average price in New Zealand are around 908,000. Hamilton a little bit behind that on 787,000. Tauranga just over the mill. Wellington around that $893,000 mark. Christchurch looking affordable at 741,000. Maybe that's driving some of the value that is driving the results in terms of sales. And Dunedin back at 616,000 as an average, or 617,000, somewhere around there. So moving on from that, Stats New Zealand data has also come out in the last week around building consents for the period to the end of September, so a little bit earlier. And overall that's down 20%. So it's around about down 10,000 houses on this period a year ago, so, or at the peak in May 22, 10 or 11,000. So it's a meaningful difference. What does that mean? I think it means less work on the horizon for the construction industry. We'd expect to see unemployment in that sector start to increase. We have seen a number of companies within that sector fall over. And what that does ultimately is solve our inflation issue in terms of cost to build, because when you lower the demand, obviously you start to correct some of those supply issues. So whether it's labour costs, which is the big one, or whether it's some of those material costs, we could expect to see that cost to build come back, I guess, in the next 6 to 12 months off the back of lower consents, meaning lower volume of houses being built. And I mean, we've seen a massive run in terms of construction, you know, the biggest in 50 odd years. So you would expect that at some point that was going to come back a little bit. You know, that was all that sort of pent-up pressure on the housing industry that we saw kind of the early first-term Labor government struggling with, and then really kind of just doubling down on it and going kind of pendulum the other way to the point where we've just got so much development going on at the moment and so much to come through both in the public and private space over the next 6 months. So what's been built? 22% of those consents are in Auckland, and to be fair, it's kind of mainly multi-unit townhouse apartment. Well, it's probably 50-50 multi-unit, 50-50 standalone, but a little bit more towards multi-unit, which is what we expect to see with affordability being more at that townhouse and apartment end of the market now. So yeah, still you know, a big chunk of it in Auckland, but 22%. Christchurch is, I think, not too far behind that, and obviously what we have seen is a continuation of Queenstown, Wanaka, Christchurch and Tauranga being really high growth areas, so we expect to see that continue. I want to talk a little bit about interest rates now. You know, they keep going up, and this is something that I guess is putting a bit of pinch into the wallets of the average New Zealander. Just in the last sort of while, the fixed rate side of things has continued to go up, with particularly BNZ and ANZ increasing their rates. And it's the usual kind of 0.16 to 0.25% sort of range. BNZ's 1 year rate, they've actually put that up by 0.16 to 7.25, and they also recently increased the longer end of the scale, the 3 to 5 years, by around about that 0.25% basis too. So they've kind of shifted overall now their rates up by around about that 0.16 to 0.25% mark. ANZ's done a similar shift. They increased their 1 year rate up to 7.39. That's for under 80% loan to value ratio lending. We're continuing to sort of see some uncertainty around where those rates are going, and therefore most borrowers that we're seeing are still sort of looking at interest rate strategies that allow them to kind of hedge their bets a little bit. And generally we're seeing sort of split rate options, so people putting some on the sort of shorter term 1 year, but generally a little bit more on the 2 to 3 year. Whether that changes, I mean, we do expect, and economists are suggesting that we will see interest rates come back in the near term, but I don't think there's the confidence there at the borrower level yet, and I expect to see some sort of risk-averse strategy there for some time to come, with people expecting that this could drag on for another 12 to 24 months, and therefore putting a bit more into that bucket. But maybe having a third or something of that in that 1 year bucket, so that if things do come back sooner, they can take advantage of it. So yeah, interest rates bouncing along there, and the cause of it really is just the cost of wholesale funding from offshore. Swap rates just gradually creeping up at the moment, and I think that's sort of pressured by some of the global stuff that's going on in terms of instability, more so than economic. But there are things like the China situation, which we really don't understand in terms of good clarity as to what's going on with the finance side of China. It's had a massive implosion in terms of its real estate markets. Some of its largest companies, which are real estate companies, have got into serious trouble in the last 6 months and have had government bailouts. And obviously those sorts of things are rolling into that rate picture as well. Higher risk, higher rates, essentially. But on the back of all of that, our RBNZ came out this week with a bit of an update and a report on our financial resilience. And generally, although they show or they talk to the fact that we've got a very high cost of living in New Zealand at the moment, and that pressure from higher interest rates is affecting us, overall, the Reserve Bank report itself is actually relatively positive about our national fiscal position, and with the exception of a few areas like commercial property, which has definitely got some headwinds at the moment, they are relatively positive about our ability to maintain and cope through this tail end of our recession that we're in. And on that commercial property piece, I guess that is something that a lot of people are aware of. Post-COVID, we really haven't seen the recovery of the retail sector. And so that retail commercial property sector has certainly been hit. And that's not just a New Zealand thing, that's a global thing, and it's almost a structural change as we move to more online shopping, which we've grown more and more accustomed to throughout the COVID period, and now we really like and we're really embracing. So what happens with residential commercial property? I suggest that we're going to see quite a bit of redevelopment. And that probably goes for office space as well. I don't know that we're going to see growth in that office space market for some time to come. And what you're seeing offshore, and it will happen here, is that more floors that were traditionally office space will get rezoned into residential by councils in order to get the value back out of those buildings and ensure that both rental income and rate income is sustainable going forward. So that's kind of it for me this week. I guess the key things there are I'll start again, Cleo. So that's about it for me this week. I guess the key things there are there's some optimism around sales coming out of that CoreLogic House Price Index update. There's a little bit of a dark cloud around the home construction side of things as we see consents drop back. Obviously, we're seeing South Island looking a little bit stronger. I mentioned Christchurch. Christchurch consents are actually strong compared to elsewhere in the country, and that lines up with the kind of strength of the growth they've had in terms of house prices as well. So watch out South Island. I think we're going to see more growth in terms of population in the South Island over the next few years. That's my bet, as Auckland just becomes harder to deal with in terms of cost of living and where valuations sit. And interest rates, we've got no certainty there at the moment, and we've seen those increases, so we expect that people are going to stay a little bit cautious around how they treat interest rates over the year ahead. So that's kind of it, and that's where I see things at the moment. Look forward to catching up with you again next Monday. Talk to you soon and have a great week ahead.